Hello everybody, this is Mel the Scientia Trader here, and I am kicking off a new series of webinars. For those that have followed me on my journey last year, you will have remembered that at the end of July I completed a 5-month project, and at the end of that project I decided to sort of swim off into the sunset and simply just enjoy the profits that I'd been accruing over the period of time that I've been trading. And certainly some of you have kept communication with me over the last 6 months, and I got a bit of an itch to initiate a new project, but one which would actually be a bit more challenging and one which would clearly allow you to also understand by how thinking big and expanding your mindset in terms of what's possible, that you can achieve big things in sports trading and not be constrained by other people's opinions or what other people say because of the fact that they haven't yet got the magic ingredients to build the level of income that is truly possible, providing you've got a system that has the science and the math to support and justify it. So the 90,000 project is the new project which I'm kicking off, and I'll be talking about it a little bit later on in the webinar. But again, it's great to be talking to you again, and I'm just hoping that the journey for this year will be something even more powerful than what we saw last year. Last year was very much just a microcosm of what was possible, but I always felt it was good to start off very small so that people could actually resonate with it, because obviously a lot of people are actually still in the development stages of their trading journeys in terms of trying to get something sustainable, something working, something profitable. So today is part one, the introduction, and I thought it would probably be best to really kind of start off by talking about last year. So last year, as many of you know, I started a project which began in March 2018 and ran it for 5 months. And the whole idea behind the project was really to show that a systematic and probabilistic approach to sports trading is very effective in building income rapidly whilst minimizing volatility. And I don't really want to kind of talk too much about things that I've gone over before, but clearly one of the reasons why I started the whole Scientia program was because of the fact that before then I was one of those people that was really always looking for the next best thing in terms of systems and strategies. And as a result of that, I was very, very vulnerable to silver spoon sales merchants that were selling systems where the big motto behind the system was that it had a very high win rate. So, they would come out with figures like, over the last 30 trades, there's been 26 winners, 27 winners. And at that time, I was very naive. I didn't really truly understand the fundamentals of probability. And so I was always taken in by, great catchy headlines like that, not realizing that when I then purchased the systems, I was never able to make sort of sustainable income because of the fact that a lot of these systems, while promising high win rates, had terrible reward to risk ratios. And so, I was there risking £100 to make £20 and being told that, well, if you've got a system that wins 70 to 80% of the time, then you'll make money on this, not realizing that I was actually adopting a probabilistic model, which was actually always going to work against me in the long term. Minimizing volatility was also very important for me as well, because again, one of the things that we're always going to encounter is variance. And variance is not a nice thing, especially when you've got sustainable variance which could be lasting weeks or even months. So for me, again, another component was really looking at was there any risk management tricks that I could kind of build into my whole ethos, which could actually help to minimize volatility and help to protect my greatest asset, which is my mind. As you know, a big part of this journey is the psychological aspect, and the more that you can preserve your mind, the better. And so minimizing volatility was very important. And the whole purpose behind the project last year was also to help contribute to my self-discipline, because just like myself, I'm sure you're aware that being a retail trader is a very, very lonely journey. It's not like working in an office where you've got a manager or a director looking over your shoulder. It's very much a sort of lone ranger kind of employment in terms of retail trading. And so you don't really have somebody there to kind of tell you, look, Mel, you're straying outside your trading methodology, or look, Mel, you're generating the wrong emotional response to situations that have happened. And so as a result, as a retail trader, you're very susceptible to deviating from your trading course, your trading plan, which can then really have significant negative long-term effects in terms of your ability to actually break through. So the fact that I was actually publicizing my results was fantastic, because I realized that, I live or die by my results. And if I'm going to make any sort of stupid errors because of the wrong emotional or psychological response to what's happening, then it's going to reflect in my results. And despite talking a good talk, people are going to see that I'm not really able to follow what I'm preaching. And results are really important, because results are the basis by which a system is measured. And in the financial trading space, you probably would have over the years noticed there's been an increase in the number of social networking platforms that allows people to share their experiences, share their journey, share their results, so that you can learn from them. I mean, one of the things that really, really amazes me in sports trading specifically is how a lot of gurus and a lot of system sellers really have a hard time being transparent about their results. It's almost as if having losses is a sign of weakness. And I kind of think that obviously because of our educational system, where we're trained to think that anything lower than a 70% win rate is really pretty much garbage, that has kind of obviously had a big impact in terms of how we come into trading. And so, a lot of traders or a lot of system sellers that I'm aware of, you hear about their fantastic trading results, or their fantastic trading weeks, or their fantastic trading days, but then they go quiet when they have losing days, bad losing days, or bad losing weeks, or bad losing months. So for me, it was very important to be transparent so that people can see the journey. Trading is a combination of wins and losses, and you cannot statistically really get to grips with the whole concept of probability unless you understand that losses are part of the equation, because you can't work out your trading expectancy, you can't work out your expectation. There's a lot of various statistical components that are very much based on wins and losses, and understanding the journey of your system. So for me, again, it was important that I'm transparent with my results. So you see the good, the bad, and the ugly. You see my great days, you see my bad days. You see my good weeks, you see my bad weeks, you see my good months, you see my bad months, because it's that level of transparency which is wholesome in terms of helping people to really resonate with the journey, rather than just seeing somebody posting positive results all the time, because that really is completely irrelevant. And so the whole purpose of the Scientia project last year was to really provide hope to those who are fed up with the same old betting trading approaches that either don't work, or are too volatile, or are too slow in building equity. And that last point, too slow in building equity, was a key point for me, because I remember back in the olden days where I was coming across system sellers that were telling me that, well, if you've got a £20,000 account, you can grow it by 50% in 12 months to 30%. And I'm thinking, really? Do I really have those years left in my life to wait that long for something to really build as fast as I want it to be? And so that was why I was always pushing a lid. I was always pushing a lid, pushing the ceiling, and I was always going into forums under different aliases and testing out people's opinions and testing out responses, only to find that most people are actually all part of the same mentality, in terms of that they feel that it has to be a very slow process. And what I'm trying to do with this project for this year is show you that it doesn't have to be a slow process. And I make no apologies. I don't care that 95% of people may have the wrong expectation. For me, based on the experiences that I have, I know what is possible, providing you have the right math, the right probabilistic insight into how to grow your account and do it in a way where you're not actually risking risk of ruin, or you know, doing ridiculous percentages of your account, like liabilities of 5% or 4% or more. It's a very traditional risk management approach, but one which clearly shows you how with a 15 grand account you can grow it to over £90,000 within a state of 6 to 7 months. So that's what I'm aiming to show you for this year. But what I wanted to do was really just look over last year. So last year I started with an initial bank of £5,000 at the beginning of March. And at that particular time, I was using trading liabilities of 2%. So what that basically means is, with a £5,000 account, well, 1% is £50, so 2% is £100. So for the trades I was putting on, it kind of averaged around £100. There were times where it went up to 125, 150, but I think overall it was probably around the £100 mark. And over the 4.5-5 month period, I actually grew, or I actually made profit of £14,000. Yeah. So this wasn't the bank. The actual bank actually would have grown to 19,000. But what happened was, at the time, it was one of those accounts where I was constantly taking my profits out, because I was obviously living. I do this for a living. But basically the profit that was made was actually £14,000 or £14,500, which kind of equates to around just over £3,000 per month. And using this website, which is a great website called the Salary Calculator, I was able to show that, well, if I'm generating £3,000 profits per month, and remember, sports trading, there's no tax liability, so we're talking about net profits here, that was the equivalent of somebody that's on a salary of £53,000. So for somebody on a salary job, where they're having to pay income tax, national insurance contributions, for them to take away over £3,000 per month in terms of net salary, they would have to be on a salary of £53,000 per annum. And here you can see the rise of my equity curve over this period of time. You can see that there were periods of sideways movements, and there were periods of declines. So you can clearly see that the overall trajectory of the equity curve is one that is positive in motion. This project actually it was over, I believe it was just under 140 trading days that the journey encapsulated. So you can clearly see what the equity curve, it was certainly a positive moving equity curve, and that's the sort of proof of the pudding for the project last year. There have been certain changes I've made, which I'm going to talk about in terms of how I trade. I'm no longer trading at 2%. I'm trading a lot less than that. But again, you know, depending on where you are in your walk of life, for some people, £53,000, you know, a salary of £53,000, you might think that's not really much. But then for others, you might think that's a great, you know, that's a great second income to make, especially if you're somebody that's looking to keep full-time employment and have something on the side. Then, you know, being able to earn an additional £53,000 a year, I'm sure would make a big difference to your cash flow. Okay, so sort of moving on, the foundation of if there's anything which I want you to grasp from all my webinars, everything I'm going to talk about, if there's anything I want you to grasp, it's the key principles which what for me are the foundation of what I believe. This is like granite to me. This is like steel foundation. Without this, I get tossed around on my trading journey. Like when you're watching a palm tree bending under the onslaught of a hurricane on a tropical island. And this is what holds me in place. And my foundation, or my whole philosophy, is built on three things which are all interlinked. And that's reward to risk ratio, win rate, and the number of occurrences. Now, the reward to risk ratio and the win rate are very much dynamically in sync. So the way that an exchange, if we talk about the Betfair exchange, well, what's an exchange? An exchange is basically an electronic medium that allows buyers and sellers to come together and exchange trades, essentially. So when on Betfair, if you're actually buying low, um, and then you sell high, then there's going to be somebody on the opposite side of that transaction. So there's always either going to be a winner or a loser every time a trade takes place. And so with any exchange, whether it's a Betfair exchange or if you actually look at some of the exchanges out there in the financial markets, like the currency exchanges, you have an exchange where you have the pairs, the currency pairs, whether it's the euro versus the dollar or the pound versus the Aussie dollar. And then even if you look at other exchanges, like if you look at some of the indices out there, like the FTSE or the S&P or the Russells or the Nasdaq, all of these exchanges are dynamic in the sense that as your win rate comes down, or whatever model you have, whatever the win rate is, if the win rate comes down, then the reward to risk ratio goes up. You can never have a system where the win rate is 90% and the reward to risk is like you're earning sort of, you're risking 1 to make 4. The exchanges are not built like that, because if they were, then everybody would be billionaires right now. So bearing that in mind, you really have to kind of make a decision as to, well, what type of trader are you going to be? Are you going to be a trader that's more looking for high win rate systems? Because if you are that sort of person, then you're going to have to accept that your reward to risk ratio is not going to be favorable. Whereas if you're somebody that is a very strong believer in reward to risk ratio, having a very strong reward to risk ratio, sort of like 2 to 1, 3 to 1, 4 to 1, in terms of, I'm risking 1 to make 4, or I'm risking 1 to make 3, or I'm risking 1 to make 2, then you also have to accept that your win rate will not be high. And that's really just, these are sort of like universal principles when it comes to dealing with any sort of exchange, trading exchange, that the reward to risk and the win rate are dynamically in sync. And so the other component is the number of occurrences. So this is basically talking about, well, in terms of the system you're following, how many trades on average is it able to generate on a daily basis, a weekly basis, or a monthly basis? And the reason why this is very important is because this also has a direct impact in terms of being able to meet the financial expectations that you might have in terms of how much you want to earn in a given period of time. So for instance, it's no point having a system which is a profitable system. So, the dynamic sync between reward to risk and win rate works for you. It has a positive trading expectancy where you will make profit, but there's no point having a system where it only generates 5 trades a month, unless you're going to be trading big size, which would then mean that you need a very, very large trading account, because you don't want to be trading big size on where your liabilities are completely out of sync with your trading bank, and putting you at the potential of risk of ruin. So number of occurrences is very important. And a lot of people kind of forget about the fact that, well, you might have a system where it's a profitable system, but if it's not generating the number of occurrences in terms of the number of valid trades that you can take, then are you ever going to meet the financial objectives that you want to meet in terms of how much you want to make within a particular period of time? So these particular three components are the bedrock of what I believe. Now, what I wanted to add is, if you're somebody that is an avid believer in high win rate systems, then you can still make profit. And that was something that I just wanted to clarify, because I know that there are methodologies out there where, it might be a methodology where it has a 70% win rate or a 75% win rate. And so your reward to risk might be 1-to-1, or it may even be less. It might be a 0.75 to 1, or even a 0.5 to 1. And I know that there are people out there, for instance, if you're a scalper, then, as a scalper, you're not going to be sort of focused on reward to risk. You're going to be looking at taking lots of tiny profits. And so, something that has a 1-to-1 is probably going to be something which is more favorable to a scalping activity. And so a 1-to-1, on average is probably anything from 65 to 75% win rate. But for me, in terms of my psyche, and this is again where it comes down to what is your trading mindset and what is the type of psychological makeup of who you are as a person, because that's really ultimately going to define which route you go down in terms of whether it's a high win rate or a low win rate. But again, regardless of whether you're a believer in high win rates or low win rates, these three components here are really integral to the whole understanding of probability and risk management. Now, in terms of the way I trade, and this is something that I wanted to just briefly go over, because this is something which I talked about and I showed this on slides from last year's webinars. But the way that I trade, and this is something that will become a lot more visually insightful as we go along, but the way I trade is I kind of sort of perceive my trading journey on a daily and a weekly basis, probably more on a weekly basis. I kind of see it as a series of oscillations, which basically means that there's going to be times where I'm going to be making profits. Then there's going to be times where I'm losing money. Then there's going to be times I'm making profits, and then there's going to be times I'm losing money. And so I kind of perceive visually my whole sort of trading journey as a series of oscillations. So what is key for me is being able to apply to this kind of oscillation model the principle of maximizing or pushing my winning days and then cutting very quickly my losing days. Now, you will have heard in trading the whole concept of, make your winners run and cut your losses. Now, sometimes that might not really be applicable, especially in terms of what I do, because my losses are always predefined from the start. So I can't really cut my losses because my loss is already predefined. I know that my losses are always around £150, and when it's £150, that's my loss. I can't cut it before it gets to 150, and I can't let it run after 150. It's always predefined as 150. However, I can still take that same concept of letting your winners run and cutting your losses and apply it not to my individual trades, but to my individual days. So in my individual days, what I'm looking for strong-handed days where I'm making profits. But as soon as I sense that there's a turn in the direction of my trading results for the day, where I seem to be now on a slippery slope, rather than go all the way down, so incur loads and loads of losses, hoping for the trading results to turn again, what I will do is jump off here. So once I reach a particular sort of value in terms of my losses for the day, then I will jump off, because what I'm now doing, I'm waiting for the next positive upward turn of the oscillation. Okay, now some people, they will just, you know, for instance, if their system says to them that, you know, there's 25 or 30 potential trades in a given day, they will simply just trade every single one of them, regardless of whether they're winning or losing money. And that's something you can do. That's another option, or an alternative strategy that you can follow, where you simply just trade every single opportunity in the day that meets your system requirements. But for me, what I like to do is basically stay on the journey while I'm making lots of profits. And as soon as I sense that the trading results are starting to turn, then I jump off and I wait for the next day. And we'll see how this applies. This is something which is actually a concept which came from what I call the sniper approach battle plan. And essentially what that means is that every single given day, there's going to be a collection of results that you could never have foreseen. And it could be any combination of wins and losses in any sort of particular order. Whether you start off with 3 wins, then it's 2 losses and 3 wins. You could start off with 2 losses, then have wins. Every day is going to present a unique arrangement of wins and losses, and this is part of what is called the normal distribution process of probability, in the sense that you cannot predict on a trade by trade basis what's going to happen. So what I try to do is I basically hold to a concept where I push my premium hands. And the premium hand basically means where I start off very strongly for the day. So that might be where I may have my first 3 or 4 trades might be winners, or, you know, because my reward to risk, because my reward is larger than my risk by 3 to 1 right now, and I'll talk about that a little bit later on, but because I'm earning 3 times more than I lose, it can even mean that I can start off with 2 wins and 2 losses and still be in quite a favourable position to move on and push more trades, because of the fact that I'm in a real sizable profit. But then also, I also think as a risk manager, in a sense that if I start off with 3 losses for the day, or somebody might say, well, if I lose my first 4 trades, then I'm going to stop, because that is my limit in terms of my losses for the day. That's almost like a stop loss or a risk management cap, because at the end of the day, you've got to think like a risk manager. So you've got to almost think like, well, if I'm handling a portfolio of client funds, what is going to make me comfortable in terms of how I treat their funds, knowing that if I just trade every single trade, regardless of whether it's up or down, you know, I could hit 20 losses in a row, and that makes a huge drawdown in their account. So for me, I kind of see that there's, for myself, in terms of protecting sort of my psyche, my psychological, you know, infrastructure, I minimize my losing days, and we'll see again later on how that actually helps in terms of decreasing and minimizing volatility in terms of my equity curve. And premium hands and this whole sniper approach, was actually based on an experience I had. About 12 years ago, I went, one of my friends, it was their birthday, and we went to paintballing. We all went paintballing. There must have been about 25 guys. And obviously we were divided into 2 teams. And there was one particular exercise where I can't remember it now. I believe we were on a bus, a double-decker bus, and we had like a some sort of treasure chest, and the opponents, the alternative team, they had to try and basically come and try and overrun us and get the treasure chest, which was on a double-decker bus. Now this double-decker bus was in kind of like a foresty range, so there were lots of trees, lots of shrubbery, lots of wood, and lots of places where one could be concealed on. And so what was quite funny was when the opposing team was coming to us, I kind of remember most of us who were trying to protect the bus, once we sensed there was movement in the bushes opposite us, we simply started firing off all our rounds. We couldn't even see. We just knew due to movement that there were people that were coming. We couldn't see them specifically, but we were shooting and shooting and shooting. And, we did take down quite a few of the guys. But I always remembered that there was a guy on our team who was actually perched on a tree that was overlooking our bus. And he was basically firing off, I would say probably one shot every 10 seconds. And it was incredible because he was actually taking down more guys than those of us that were actually shooting off our whole rounds of pellets. And, a lot of us were then running out and then having to run into the bus to seek shelter because we didn't really have our means of attack, which was our weapon. But it was just amazing watching this guy, how he was taking down such a high percentage of the shots that he was taking. There was such a high percentage of fatalities he was causing on the other side. And I remember speaking to him after, and I got to understand that he actually did shooting as a hobby. And he was talking about, as a sniper, when you're shooting, some of the fundamentals that makes a very good sniper are fundamentals such as patience, looking at reward to risk, and also just unbelievable discipline. And that really kind of resonated with me in terms of trading, in terms of sometimes we want to just shoot off all our rounds by taking every single trade we can take, not realizing that if we have a much more meticulous and more strategic sniper type approach, whereby we're looking to maximize our upside and minimize our downside, then we put ourselves in a much, much stronger position on a long-term basis. So moving forward, so last year I kind of finished the 2018 project. I believe it was at the end of July. And after that, I kind of said that, I was going to continue trading, but just do it in private. But there was going to be a number of things I was going to do in terms of taking the brakes off so that I could actually start to increase and expand on my profit potential. And these were some of the things that you may remember from the very last webinar I did last year. And so what I wanted to do was just run through this so you can clearly see where I am today based on these key points, which I saw as an integral part of me being able to actually expand my profit potential. So one of the things I talked about was increasing my reward to risk ratio. Now I think back then my reward to risk was 1.6 to 1. So based on the type of trading I was doing, I was going in where there were opportunities to make 1.6 times more than what my risk was. So if I was putting on trades where the liability was £100, then if the trade went in my favor, I would be making on average about £160. And at the time, I was actually, focusing on late goals. But one of the things that I wanted to do for the project this year is really kind of just take a step back from whether it's late goals or whether it's this or that, because to me that is sort of like like when you go to your doctor and you've got something wrong and he prescribes you a pill or a medication. Most of the time what he's doing is prescribing you a superficial short-term treatment. But a lot of the times the symptom you have is actually indicative of something that's more deep rooted and more embedded, and you would probably have to see a specialist rather than a GP. And the reason I talk about that is because I kind of feel that sometimes when I talk about the types of trading I do, whether it's late goals or looking at opportunities where there's going to be 2 goals scored in the second half, or looking for opportunities where after half of the first half or after 30 minutes of the first half, I'm looking for 3 goals to be scored in the game. I kind of feel sometimes that talking about that too much actually detracts away from what the actual underlying component is. And the underlying component is that I'm always looking for trading opportunities where my reward is much, much bigger than my risk. And I think that's where I want the conversation to go, rather than Mel, late goals, what do you do, blah, 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 because to me that's irrelevant. What is relevant is that you're able to find opportunities um, on the Betfair exchange where you're able to find opportunities where you're able to make trades or take trades where your reward is a lot bigger than your risk, and where you found a niche system where your win rate is able to support and justify profit based on what that reward to risk ratio is. But just for the sake of this slide, obviously, last year I was focusing just on late goals. But this year, what I've managed to do over the sort of months since I've last spoken to you is I've actually slightly changed now. So no longer am I looking for opportunities where my reward is 1.6 times bigger than my risk. Now I'm looking for opportunities where my reward is actually around 3 times bigger than my risk. Now what that basically means is that it's had an effect on my win rate. So whereas before, when I was looking for opportunities, 1.6 to 2R, now that I'm looking for 3R, my win rate is now lower, because remember I talked about that dynamic with the exchange system, that if you're looking, the higher the win rate you're chasing, the lower your the higher the reward to risk you're chasing, the lower your win rate. And so now I've just accepted that my win rate is now a lot lower. In fact, I think my win rate is averaging sort of around 43%. Now, years ago it would have been, oh my God, I'm losing 57% of the time. That's disastrous. This is a big issue. But you kind of mature in your trading, and certainly for me, I don't bat an eyelid now. Also, what I'm doing is growing my bank. So whereas last year, I think my bank was sort of staying at 5k, even though I was making profits, my bank kind of remained around 5k because I was always drawing profits out in terms of income, in terms of paying off things, in terms of investing in other things. But this particular project for this year, my bank is 15k and it will continue to grow. And what that basically means is, it just means that you're going to see some real significant exponential growth, because of the fact that if I'm applying a percentage-based risk-based model, then as my bank grows, then obviously what's going to happen is that my income potential is going to grow as well. So that's one big difference, which is going to help me to really scale up in terms of my profit. And yeah, number 3, applying a percentage based risk management approach rather than fixed risk. Fixed risk basically means, as you know, that the size of my trades are always going to be the same, irregardless of whether my bank is going up or going down. So last year, my bank was £5,000, and even though I was making profit, because I was taking profit out all the time, I decided that I would just apply a fixed risk management approach, where my trading liabilities were constantly around the £100 mark. But for this year, this project, it's going to be percentage based. So right now, with a 15,000 bank and with a 1% liability, my trades are £150 liability. But if my bank hits 25k, 30k, then using that same 1%, it would basically mean that my risk would increase now to £300 in terms of the risk per trade. But £300 to risking £300 to make £900. So that's the power of percentage-based liability, and I've reached a position now where that's what I'm now employing as part of my daily routine. And the thing is, I'm completely at peace with scaling up, and I'm not worried about losing streaks, and I'll talk about that on another slide. And that's part of the reason why my percentage liability is no longer 2%, it's 1%. And there's a slide, very, very, very effective slide, which communicates the reason why I've decided to make that decision of reducing my liability from 2% of my bank to 1%. I also talked about possibly gravitating towards a leveraged way of trading, and leverage is something which I talked about in one of my webinars. But I've decided that I'm going to stick with a 3L model. 3L basically means, like baseball, that when I get 3 strikes, I'm out in terms of my in terms of the losses that I've accrued. So if I get 3 losses in my first 3 trades, or if my first if my first trade is a win, but then I get four straight losses after. So if it's a 0-3 or a 1-4 in terms of, wins to losses, then I will basically stop for the day. And that's what I call a 3L model, because you're waiting for that 3L, 3 loss factor to kick in. I was looking at the 2L model, but I'll just be honest with you. Psychologically, I'm not built for 2L. I tried 2L and it was very difficult because 2L you have a lot more. There's a lot more volatility, even though the profit potential is a lot bigger. But I just found that I needed to work with something which psychologically I could embrace and know that I could sustain it, rather than always feel like for some reason my inner voice is rebelling against it. And I think sometimes in trading you just have to be honest about what is actually going to make sense for you based on your psychological mindset or your psychological setup. Because I know that there are traders out there, especially trend following traders, who work with win rates low as 20%. What that basically means is that they're dealing with, reward to risk, where they're probably making 10-20 times more than their losses. But 20%, I mean, with a 20% win rate system, you are very much exposed to losing, 20-25 losing trade sequences, and I'm not built for that. So you've got to be honest. You've got to be honest with yourself. You've got to have a high level of integrity, so that when you actually do adopt a particular methodology, that it's something that's going to be sustainable for you. I mean, trading is already difficult as it is, let alone going into something that you just rebel. Your superconscious is rebelling against, and it's just causing you a lot of aggravation and a lot of inconsistent results. Number 6, ensure access to alternative options to Betfair to address limitations and opportunity. Now, last year, one of the things that I was doing was I was using Bet365 almost as a kind of supplement system, because with Betfair, a lot of the markets that I wanted to go into, Betfair wouldn't carry them consistently. So we're talking about a lot of the more sort of exotic leagues, like the Chinese league, the Vietnamese league, Thailand league. These are leagues which were built, which had the statistical models that were great for the type of trading I was doing. But I was continually having problems where when I wanted to make the trade, Betfair wouldn't make those opportunities in play, because obviously I trade in play. And so what I did, I was utilizing Bet365, because even though they're not an exchange, they're a bookmaker, but they do have in play betting, which gives you options to a lot of those exotic leagues. However, what I decided to do was I made some changes to my approach, which helped me to scale up the number of trades I could do on Betfair. And what that's done, it's negated the need for using Bet365. Now, one of the other reasons that I have done this is, number one, reporting. So it just means that when I actually show you my results, that you're not having to see Betfair and Bet365. You can just see everything under the same Betfair model in terms of looking at the results. But the other thing is, because I'm now applying percentage-based trading, it would be inconceivable that I could use that with Bet365. And the reason for that is because Bet365 is a bookmaker. It basically means I have to be very careful about the level of profits I'm making and how I scale up my liabilities. So with Bet365, whilst putting on liabilities of £150 is probably fine with, well, it is fine with them, because that's what I've been doing. If I was to scale up to putting on liabilities of £300 or £500, where let's just say, for argument's sake, my liability is £500 and my reward to risk is 3 to 1. So that basically means that if I'm putting on a trade of £500, I'm winning £1,500. Yeah, but who am I winning that £1,500? I'm winning it back from Bet365, and that's why you always got problems with bookmakers, because once they start to see you as somebody that's constantly taking money from them, that's when they start becoming silly and looking at placing limitations on your account, And so I realized that, well, if I'm sticking at quite a sort of moderately low liability on Bet365, it's not going to be a problem, especially because of the fact that the bulk of my trades are going to be on Betfair anyway. But once you start sizing up on a bookmaker, that's why, you can then encounter issues. So that's why I decided, well, how can I make some sort of strategical changes to the way I trade so that I can increase my potential number of trades on Betfair, which essentially means that I can still look at the whole. I can employ the risk the sort of um, the percentage-based risk management approach, knowing that on Betfair it's no big deal because Betfair make their money from the fees on trades, and rather than worrying about how much you're making. Okay, number 7, identifying additional non-late goal strategies. So I think what I was talking about was I didn't want to just be based solely on late goals. I wanted to look at other options to help increase the number of occurrences. Remember, I mentioned that the third component of that equation is number of occurrences. And so for me, I need to make sure that I've got a number of strategies in place to generate the potential number of trades so that I can hit a particular threshold of trades per week, so that I can hit a particular financial metric per week and per month. And so I needed to make sure that I've got enough strategies which generates enough trades, so whether it's spring, summer or winter or autumn, it doesn't matter. I will always have a good pool of trades to sustain me on a daily basis. And I kind of felt with late goals that there were some times where things were a bit thin on the ground in terms of the number of available trades. So I actually, over the last 6 months, have worked on developing some other trading opportunities, which are not necessarily late goals. But again, all the trading opportunities I focus on are all based on the fundamental concept of basically making a lot more from my winners compared to my losses. And right now, what I'm making is 3 to 1. So I am winning 3 times more than I lose, with a win rate of 43%. Okay, so moving on. So what I wanted to talk about is, well, where are you today, Mel? That's one of the questions that a lot of people keep asking me is, where are you today in terms of your trading? Well, where I am in terms of my trading can be boiled down to this. And so what I've done here is really just giving you the core components of how I'm trading. So as I said, my reward to risk now is 3 to 1. So whatever trading methodology I'm using to generate my trades each day, I'm always going in at opportunities where I'm so essentially what that means is, because my liabilities are around £150, it basically means that my reward is normally anything from £450 to £500 per trade. Yeah, in fact my reward to risk is actually around 3.2 to 1, but just for the example of this presentation, I've kind of just rounded it down to 3 to 1, and my win rate is 43%. So remember, I think last year my win rate was sort of around 50 to 55%, but I had to condition my mindset. I had to condition my psychology, and I had to re-engineer my mindset to accepting the fact that my win rate was going to be significantly lower. And so because of that, I've also had to grow balls. I've had to accept the fact that I could go on a run of 12 to 15 losing trades in a row if it happens, but that's part of the journey. That's part of the terrain. If you're looking for big wins, big trading wins, big profits, and big weekly or big monthly potentials, then you have to grow the balls to accept the fact that you've got to take the long streaks of losses as part of the terrain. My objective is basically to trade 130 times a month, and that boils down to on average around sort of 30 to 35 trades a week. And so all of those strategies, the 2 or 3 strategies that I use to generate my trading portfolio per day, altogether it helps me to hit a target of 130 trades a month. My bank size right now is £15,000, and my trading size is 1%. Now my trading size used to be 2% when I had the smaller bank. I think it was like £5,000. But my trading size now has gone down to 1%. And I want to explain to you the reason why, because this is quite important. And the reason it's important is I remember not so much in financial trading. In financial trading, what you tend to find is most people will talk about, having a trading size where you're not putting on more than 1 to 2% of your bank. Yeah. Certainly, if you've got, $1 million portfolios, and probably you're only putting on 0.5 or 0.25%. But let's just say, for argument's sake, your trading bank is, £5,000 to £10,000. Then what most trading gurus will tell you in financial trading circles is that you shouldn't be trading more than 2%. Now, what I was finding in sports trading is that I was hearing people talking about putting on trades or bets of 4%, 5%. And I'm thinking to myself, now when I think about it, I'm just thinking to myself, well, do people really understand the damage you can do to your account if you start veering into that 4-5% range? God forbid, even more than 5%. Because what you've got to understand is that when you start hitting losing streaks, you've got to understand that there are particular triggers in your brain based on your makeup. And those emotional responses could actually work against you. Once you start seeing your bank decreasing significantly, are you going to still stick consistently to 4 to 5%, or are you going to start to lower because of fear and then completely screw up your whole, your whole risk management model? So this is what I wanted to show you. Now, as I've said to you, I'm actually using a system that loses 50% of the time. Okay? 50% of the time. Now, with a system that loses 50% of the time, it's important to understand that there is a 1% probability chance of 15 losses in a row. Now, here's something I want to show you. So what I wanted to show you was, I've got this tool here, which is, it's a probability streak calculator. Okay, so what it basically does, it actually shows you, based on what your win rate is, what the potential number, well, what is the probability of losing streaks and winning streaks as well. So in this box here, so as I've said to you, I sort of make on average about 130 trades per month. Now, I've said to you that my probability of loss is 57%, and that's because my win rate is 43%. So obviously, my losing rate is going to be 57%. So in this table, it's basically telling me that if I have a losing streak, there's a 100% chance in 130 trades. There's a 100% chance that I'm going to have a losing streak 2 times, that I'm going to have a losing streak of 2 losses 2 times, 3 times, 4 times, 5 times, 6 times, 7 times, 8 times. Yeah? In terms of having 4 losses in a row, in 130 trades, there's obviously, 100% chance of that happening 2 times in 130 trades, and 6 times in 130 trades. So basically, with 130 trades, I can expect to have a losing streak of 4 losses in a row. I can expect that to happen 6 times with a 55% probability. Okay, but what I want you to pay special attention to is here, because what the probability calculator is telling me is that there is a 1% chance that I could have 15 losing trades in a row. Okay, 15 losing trades in a row. Now, if we change it here, suppose my losing rate was, say, like you have a system that wins 70%. Well, if it wins 70%, it means that your losing rate is 30%. So if we put in 30%, you can clearly see that, with a system that wins 70% where you lose 30% of the time, that your losing runs are not going to be as extensive as if your losing rate was 57%. So here you can clearly see that if you've got a system that wins 70% of the time, which loses 30% of the time, then you could incur a losing streak of up to, the fact that it says 0.01 means that within the realms of probability that's possible, but we always tend to take anything over 1%. So even with a system that loses 30% of the time, you could still have a losing run of 7 in a row. Okay, so just going back to my system. So as you can see, because anything above 1%, I kind of base it on that. You can clearly see that there's a 1% chance of me having 15 losses in a row. So just bear that in mind, 15 losses in a row. Now in 130 trades, it's only going to happen once, yeah? But the very fact that it happens at all, I need to be aware of that, okay? Now, coming back to this slide, we've already established there is a 1% probability of 15 losses in a row. And this is based on 130 trades, which for me is normally about 1 month's worth of trades. Now, the losses are 1% because, as I said to you, I'm using 1% of my bank. So my bank is £15,000. So if every trade I put on has a liability of 1%, whilst the deposit is £15,000, then it means that the liability is going to be £150, correct? So if for a 15 loss streak, that equates to £2,250. So what this is basically saying is that if I have a bank of £15,000, if I'm putting on trades where my liability is 1% per trade, then if a 15 loss losing streak started off the bat, then what I would lose in that streak is £2,250. Now £2,250 as a percentage of my bank is a 15% drawdown. Okay? Now, here is the fundamental part. If my liabilities, or if my trading liabilities were not 1%, they were 2%, then if this 15 loss streak happened, my drawdown would now be 30%. Okay? So it's now moved from 15% to 30%. And if my liabilities per trade were 3%, so no longer is it £150 per trade, okay, but it's like £450 per trade, then what would basically happen is that using 3% risk per trade, if I hit a 15 loss streak, my drawdown would actually be 45%. Okay, 45%. So what's important to understand here is knowing this up front, knowing this in advance. I understand the type of person I am, and I know that I would not be able to handle close to a 50% drawdown on my account. I wouldn't be able to handle my £15,000 account going all the way down to nearly 7,500. Now, I know my system works, and I know that I can rebound from that, but that's a lot of mental stress to be dealing with. There's a lot of mental collateral that is involved in being able to sustain your positive energy when you're going through that type of sharp drawdown on your account. So that's why for me 1% is where I'm comfortable with, because I know that if that 15 loss streak ever happens, it's only a 15% drawdown, and I can handle that, no problem. That would mean my account, going down from 15,000 down to just below 13,000. So that's why it's very important that you understand the enormity and the impact of the risk management liability stake that you use. And so, God forbid, I mean, I'm not even going to tell you what 5% would be. I think 5% risk would probably be 75%. So you'd probably lose 75% of your bank if you were using 5% and hit that 15 loss losing streak. So, and this is why you find that when you're talking to fund managers where they and hedge funds where somebody might be managing an account of 5 million, 10 million, 20 million, you find that the risk that they're using is sometimes as small as 0.25 or 0.1%, because they're already aware that if they hit, and especially hedge funds which are trend following hedge funds, because with trend following, the trend is only going to be in your favor probably 35% of the time, which means that 75% of the time, 65% of the time, the market is trending against you. And so if you've got, if you're dealing with a system where your losing rate is 65%, you're going to be hitting some losing streaks where you could be hitting 25, 30 losses in a row. So I hope this is clear. And, when people say, 1%, 2%, they're not saying it because they're just speaking out of their backside. They're speaking of it because there are some very strong mathematical principles behind it, which helps to ensure that you protect your collateral and you don't encounter enough damage which can then cause you to actually spiral out of control, not only in terms of your account but also in terms of your psyche. Because once you start hitting losing streaks, and coupled with that is the fact that you believe or start to have the concern that your financial bank could actually sort of go into obliteration. I mean, you're not going to still follow your trading plan to the T. It's going to completely throw you off track. Okay, so just going back, so the probability metric is 130 trades per month. So if you do some sums, 130 trades per month, if we take 43% of 130 trades, you're talking that of those 130 trades, 55% will be profitable trades, 75% will be losing trades. So that is kind of like an average in terms of what I'm expecting on a monthly basis in terms of the number of trades I put on. Yeah. Now remember, I've already said to you that my liabilities are £150 per trade, which basically means that my profits per trade are £450. It's actually more 500 because the trades I'm putting on are sort of more around 3.2 to 1. But just to make things rounded and make it simple, let's just use in 3 to 1. So 150 times 3 is 450, yeah? So what it basically means that each month I should be making around £13,500 a month. Okay, now this 13,500 is kind of like what we call like the mean, because there's going to be months where it's going to be less than that. It's maybe 8,000 or 10,000 or 12,000, and then there's going to be other months where the profit generated will probably be 15,000 or even 20,000. And that's because of what we call sort of standard deviation. And I'm not going to go into that now. That's going to be for another webinar. But basically, in terms of probabilistic normal distribution, there's a bell curve, which is what is called a standard deviation, which shows you that the majority of your expectations fall within a particular range. And then the outer range on the left and right hand side are more the outliers. But over the course of many months, the average profit should be around 13,500, but obviously that net profit will increase as my bank increases. So basically what I'm saying is that over the course of 7 months, with a £15,000 starting bank, I should be generating at least £90,000 after 7 months. And that's why I've called this project the £90,000 project, because essentially what I'm trying to do is bust open this level of thinking that these sorts of expectations are simply not possible. You know, what I'm trying to do is bust open this mentality that a lot of people have, that these sorts of expectations are simply not possible. Yes, it's not possible if you haven't got the right trading methodology, if your risk reward and your win rate and number of occurrences doesn't meet the expectation of what's needed. Yes, it doesn't work if you haven't got the right mindset, if you don't have the right psychology, if you don't have the right discipline. Obviously it won't work. But if you can amalgamate all of those ingredients that I've just mentioned together and cultivate them and be like a sniper and have the disciplined approach to carry the project through, then I would hope that after 7 months I hit £90,000, and that's why I call this the £90,000 project. Can I guarantee it? Absolutely not. Lots of things can happen. So, you know, I could fall ill and miss some weeks. There might be things in my life which means that I may not be able to put on the number of trades I wanted to in a particular week, and those are the realities of trading. But as a metric, theoretically, this is what I should be achieving. I may fall short. I may hit 70. I may hit 80. Yeah. But what I'm trying to show you is what is possible. What is possible. What is possible. That is very important, because for too many years of my life, I listened to the fabrications of voices of authority in the industry, people that set themselves up in forums and always think that they're the voice of reasoning, and because they're not making the same amount you're making, you're doing something wrong, or you've got something that is going to fail. And what I'm attempting to doing is basically just shut those people up, because at the end of the day, it doesn't matter what they say, it doesn't matter what I say. All that matters is results. I'm actually somebody that is happy to be transparent about my results. Other people are not. Yet they're giving all the big talk about this, that, and the other. Yeah. And they're hiding under this whole cover about, well, it doesn't matter whether you put up trades because trades can be fabricated. Well, that's a very, very convenient shelter to hide under if you're somebody that doesn't want to show you results because you're not backing up what you're talking about. And in terms of this whole thing about showing results, I'm actually going to go one step better than last year. I think last year what I was doing, every day I was kind of generating from Betfair the list of all the trades that I've taken. I'm actually going to go one step further than that. What I'm going to do, I'm actually going to go into my Betfair trading account and show you the results on a daily basis, on a weekly basis, on a monthly basis, so that there can be no apprehension about the realities of what I'm showing you, because I think it's very important that you actually see my trading account rather than seeing me generating reports off my trading account. You need to see verbatim. You need to go to the source. So that's what I'm going to be doing. How many of those people you're listening to out there would do that, eh? I wonder. What I wanted to do now was a manual simulation, because again, for me to have some sort of expectation as to what to expect from March the 1st when I kick this into action, I like to do a lot of simulations. And one of the things, there's a lot of different tools I have to do simulations, but one of them ones that I use is Roll Dice Online. Now, Roll Dice Online is basically a website where you can generate random data from different sided dice. So in terms of my particular strategy, I know that using a 7-sided dice, I can create a 43% simulation. And that's because with a 7-sided dice, 3 divided by 7 averages to 43. So with a dice roll of a 7-sided dice, if the roll of the dice is 1 to 3, that is equivalent to like a successful trade. And if the dice roll is 4 to 7, then that is like a trade in loss. So based in terms of my 43% win rate, to replicate that win rate using dice, if I roll a dice, if it's 1 to 3, it's a win. If it's 4 to 7, it's a loss. Now bear in mind, each win is £450 and each loss is £150. Now, just some other sort of parameters. On a Monday to Friday, the average number of trades I put on a day is normally 5 trades a day. But when I get to Friday, Saturday, Sunday, the potential to trade beyond 5 is obviously increased, because obviously on Friday, Saturday and Sunday, those are the 3 biggest days of the week in terms of the number of football matches taking place. So I've put 5+ there because whether I trade beyond that 5, the 5 trades per day depends on a series of circumstances which I'll talk about later. And what I'm going to do, I'm going to run this simulation over a 10-week period, because again, what we're talking about here is not no sort of 1 week worth of results and jumping up and saying boom, 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 and then a big bang and crash. What we're talking about is 10 weeks, because over 10 weeks you really get to see the good, the bad and the ugly with the number of trades that are being put on a daily and weekly basis. So what this particular slide is showing us is, and this is what will make it easy for me when I'm doing the manual simulation, is that based on what the wins or losses are in any given day, it will enable me to pretty much quickly know what the daily profit or loss is. So I have gone through these. So for instance, if I had 3 losses out of the bat, each loss is £150. That would be my cap for the day, minus 450. If I had 1 win and 4 losses in my first 5, so if I had started off with a win and then my next 4 losses are my next 4 trades are losses, then I would stop for the day, because I've reached that differential where the differential of losses to wins is 3 in favor of losses, and so my loss for the day would be 150. But clearly you can see in terms of where the profits are as the number of wins starts to ramp up in those first 4 to 5 trades, then obviously the profit potential exponentially starts to increase. Okay, so just bear this in mind, because it's this which I'm going to be using in the manual simulation to determine what my wins, what my profits are and my losses are for each given day in the simulation. Okay, so we are in simulation mode. So I've got 2 windows open. The first one is my spreadsheet, and basically what I have here is a table which is composed of 10 columns. Each column stands for 1 week, and obviously in each week there's 7 days. So basically for each week there's going to be 7 results for what happens for each day. This here is going to be the cumulative, so this is going to be showing you the income that's building up as each week of simulation takes place. And here I've basically just duplicated what we saw in the last slide, where based on the number of wins and losses, these are what the daily totals are. Now what I'm going to do, I'm actually going to just highlight these days, because these days are very important. So Friday, Saturday, Sunday, these days are really key, and I'm going to explain why. This comes back to what I said earlier about on these days I can trade beyond 5 trades per day, and you'll see what impact that has in terms of the overall profit portfolio. This window is roll dice online, so I've got a 7-sided dice. I'm going to roll it 10 times. Now for the first 4 days of the week, Monday, Tuesday, Wednesday, Thursday, I'm only looking at the first 5 results. But on the Friday, the Saturday and the Sunday, I will be looking at all the results based on where I am in terms of profit potential after the first couple of trades. So I'll explain as I go along, yeah? So let's kick off. So roll dice. So we know that what I'll do, let me put this down here just to make it easy for us to see. Okay, so we know that if the dice roll is 1 to 3, it's a win. If it's 4 to 7, it's a loss, yeah? Okay, so let's start. Let's kick off. So in the first 5 trades, 1, 2, 3, 4, 5, 1, 2, 3, I've had 3 winners because 4, 2, and 3. Sorry, I've had 2 winners. So in the first 5, for the first day, I've had 2 winners. So 2 winners, so that's a £450 profitable day. So what I'm going to, I know this is probably going to be boring for some of you, but I can, honest to God, tell you, it's this sort of stuff that helps to build you if you're going to be into this game, especially the way that I do it. If you're into some sort of fancy surface level, quick fix, glitter type of approach, you know, where you're attracted by system sellers that are telling you boom, boom, boom every time they get a run of wins, then it's up to you to fall for that. But if you really want to understand the nitty gritty, the real infrastructure of what can create long-term sustainable income, then these are the sorts of depths you have to go to really get to grips. And simulation is very important for me because simulations, I always do a simulation every day. It's part of my daily routine to help feed my psyche with knowing what is possible, irregardless of what's happened on the previous days. Okay, so let's roll away. So the next one, 1, 2, 3, 4, 5. So in this one, I had 1, 2, 4 winners. So that's 1650. The next 5, the next day, 2, 3, 4, 5, 2, 3 winners, 1050. The next day, well, the next day's a losing day because straight out of the bat, I've had 3 losing trades in a row. Now this is where we get to Friday. 1, 2, 3, 4, 5. So Friday, okay, so Friday I've only had 1 win in the first 5 trades, and I've always said if I hit 1 win and 4 losses, then I'm out for the day. So that's minus 150. And wow, I've hit another loss there on Saturday, 450. And then on Saturday, I've had 2 wins. Now 2 wins takes me to 450, yeah? Now what I do on weekends, what I do Friday, Saturdays and Sundays, because there's obviously a lot more trades, because after 5 trades, even though I've only won twice, because I'm at 450, I will now push on. So this is almost like extra time for me. So I will push on single trade by single trade. And as soon as I hit a loss, I'm out. But as long as I continue to win, I'll stay. But as you can see, the 6th trade is a loss. So 450 minus 150, because I've hit another loss, is £300. So altogether for the first week of trading, £2,400. Okay, I'm going to roll the dice again. When I roll the dice, click here, everything will change. It will generate a new pattern of sequences. So let's go again. So there's no need for me to explain now. You should just be able to follow through and watch what I'm doing. 2, 3, 4, 5. 3 wins. 1050. Next one is 1, 2, 3, 4, 5. 3 wins again. Next one. Well, the next one is 3 losses. 3 losses again. 2 wins at 450. This is a Friday. Now, what I'm going to do now is push on trade by trade. And as you can see, the next 4 trades are winners. So after the 5th trade, there were 2 winners, 1 and 3, 2 winners, which means I'm at 450. Now I've got another 4 winners. So that's 450, which is what I've already got, plus another 4 sets of 450s. And then I end with a losing trade. So altogether, my income for this Friday was $2,085. 10 trades, that is more than possible on a Friday, Saturday and Sunday when you look at the cards for each day. Okay, Saturday. Well, Saturday I only had 1 win, so I can't continue, so a 150 loss. And then Sunday, 1, 2, 3, 4, 5. Sunday, I had 3 wins, so I'm already at 1,050. And then I've got another win now because I'm pushing on. Got another win there. That's another 450. And then I hit a loss. So that was 1,350 that I made on that Sunday. And as I've said, I only push on Friday, Saturday and Sundays because those are the days where you get, I mean, obviously, if on a Monday, Tuesday, Wednesday, Thursday, it's a good card, I could carry on. But just for the sake of this simulation, I'm trying to just show you really kind of just a grassroots, minimalistic approach, what's possible. Right, so roll dice again. 3, 4, 5. 3 wins, 1050. 2 wins, 450. 3 losses, 3 wins, 1050. 3 losses. So those people that say, you know, some of the comments I used to get is, how can you get such incredible results? Well, as you can see here, if you're looking at things on a daily basis, and you can clearly see I do have losing days, but it's, you know, look at the weeks. The weeks are clearly winning weeks. Okay. So here I had 2 wins, 450. And because I carry on a trade by trade, the next trade was a loss. So that's a £300 win. And here, minus 450. So that wasn't really a great week there. That was only £1,500, yeah? Okay, moving on. Two wins. One win. Three wins. Three wins again. Minus 450. The market's very unkind right now. Very unkind. And then this one's going to be 300. 2 wins, 450. One, two, three, four. 4 wins there, so that's 1650. Another minus 150. Actually, that should be that should be minus 450 there. So here I've got 3 wins. This is on a Friday. So I'm already at 1050. And then I've had 2 more wins before I hit the loss. So today would have been, that Friday would have been an £1,800 day. $450. Then I've had another $450 before I hit the loss there, so it's $750. And here I've had 2 wins, and then I hit a loss there, so that's £300. So rolling on to week number 7. Two wins are $450. 5. 2 wins again there, $450. 2 wins, and then a loss pushing on, so that's a £300 win. Now here I've had 3 wins, which is 1050. Then I've had another 2 wins on top here, and then a loss. So as soon as I get to that loss, I stop. Here I've had, so here I'm, this Sunday, I've had 4 wins, so I'm at 1650. When I push on, it's a loss, so £1,500 for that Sunday. I mean, it's kind of funny because you can clearly see the week didn't start off great, but just a couple of big wins and it can really actually salvage your week. Okay, so you're starting to see the power of the reward to risk ratio, because I haven't had any negative weeks. Now, there will be negative weeks, but it will be very much in the minority. I mean, I've seen people where their systems week in, week out. I've seen systems where for the whole month, every week has been a loss. But it doesn't happen with this. You may get some weeks where there's losses, but you're not going to get a whole month of loss. So week number 8, start again, week number 8. I've had 3 wins, so 1050. 1, 2, 3, 4, 5. 2 wins, 450. 2 wins, another 450. 2 wins, another 450. 2, 3, 4, 5. Here we have a minus 150 there, and another minus 150. 1, 2, 3, 4, 5. Here we've had 4 wins and then a loss. So 1650 minus 150 is £1,500. So week number 9, moving on. So week number 9, we've started with a bang, 4 wins and 1 loss in that first day. So that's 1650. Yeah, it would have to be a loss the following day, innit? That's how normal distribution works. On the third day of the week, I managed a 450. 2, 3, 4, 5. 1, 2, 3, 4. So 3 wins there. That's 1050. Now we're coming to the weekend. So on the Friday. So on the Friday, I managed 3 wins. So 1050. Then I've won again. Plus 450. And then I've hit a loss. When you get to the 5, that's a loss. So that's 1350. Right. 1, 2, 3, 4, 5. So again, 3 wins. Puts me at 1050. Plus another win. And then a loss. So that's 1350 again. And then I've ended with a loss there. So that's minus 450. So we're on to the last week. So let's see how this goes. Week number 10. Started off with a loss. 1, 2, 3, 4, 5. I've had 2 wins there, so that's 450. Two wins again is 450. Here, 4 wins, so that's 1650. Now we're coming up to the weekend. Friday, well, minus 450 there. And then 2 wins, which is so far 450. I push on, that's a loss. So 300 there. So just to sort of reaffirm again, when it's the weekend, Friday, Saturday or Sunday, after 5 trades, if I'm still profitable, I'll push on 1 trade at a time. And I continue to push on each trade at a time until I hit a loss. Yeah, that's how I work. Because the reason why I don't take on a whole barrage of trades all at the same time is because, you know, I could have a position where if I said, oh, let me take the next 4 trades available at one time, they could all be losses, and then it makes a big dent in all the hard work from earlier on in the day. So you want to kind of make sure that you preserve. You're kind of testing the water. You're putting your toe in the water to test, to see if the the market's going to be favorable to your strategy. And if it is, then you continue. If it's not, stop. No need to go on. And that's all part of risk management and being disciplined, rather than just going on and on and on and on and on and on, and simply just being at the mercy of variance. So the very last day is a loss. So that's minus, because I had one win, so it's a minus 150. Okay. So basically what we've sort of seen is, and this hopefully kind of starts to give you a picture of expectations. I'm not going to get winning days all the time. You can clearly see that there's quite a lot of losing days, yeah? But I'm still £30,000 up after 10 weeks. Do you understand? So I just want you just to look at this for a while, let it ingrain into your mind, into the ebbs and flows of how this system works on a week-by-week basis. Okay. Now, what's quite funny is over 10 weeks, it's sort of, the simulation is saying that after 10 weeks, we'll be in profit £30,000. Now, I'm trading from March till September, March, April, May, June, July, August, September, which is potentially about 28 weeks, give or take, because, you know, if we're saying 4 weeks per month, I know it can be a little more than that, but let's just say there's 28 weeks between beginning of March and the end of September. Well, what would happen if I extrapolate this? So 28 weeks is 2.8 times more than 10 weeks. So times this, if I times this by 2.8, there you go. So potentially it's telling me that after, you know, 28 weeks, I'll be around £85,000. Yeah. So what I'm trying to sort of demonstrate to you is that this £90,000 is not a pie in the sky. It's something that's based on math. It's something that's based on science. It's something that's based on fundamentals. And for me, the turning point was when I started to wrap myself around what makes the world's best financial traders tick. Because I wasn't interested in talking to sports traders, because number one, a lot of the sports traders that I know who are successful, they're operating in horse racing, most of them. And horse racing is a completely different field. It's not something that I've got expertise in. It's not something I'm interested in. And a lot of the heavyweight traders in horse racing are actually scalpers anyway. And scalping is a completely different philosophy to probability trading. So for me, the next best thing was, well, who are some of the world's best football traders? And I didn't see anybody. I would go into trading forums and say, is anybody here making £5,000, £10,000 per month football trading? Is there anybody here who's a football trader full time? And I would be met by a wall of silence. I would see lots of system developers and people saying that they've got systems and they've got football systems at work, but I could never ever find somebody. And actually, there was one person who I did see. I think what was his name? I can't remember his name, but he actually is head of. Oh gosh, the name's escaped me right now. But it was basically a system that was built around this whole thing about minimizing losses, almost having some sort of system where there's no losses, but it was about balancing other markets. And I think he was a product of Tim Lowe. So he was his system was sold through Tim Lowe. I know he was making money because we would see his records. I mean, he was making about, what was it? I think it was about £2,000 to £3,000 a week. But I couldn't. His system didn't resonate with me, but I couldn't fault him because whether his system works for anybody else is completely irrelevant. It works for him, and I had to appreciate that. But apart from him, there was no real other person that I spoke to or was willing to show me that they were actually making a ton. Now, it's not to say that there aren't people. I know that there are people out there. I mean, I know if you look at the likes of FTS Income and sports trading, those are individuals who I know are making a hell of a lot of money, but they are really the minority. There's not a lot of people that are making a lot of big money and sustaining it in football trading, unless you're like, there's hedge funds that are now involved in football trading, and big players. But in terms of the small fry, somebody like me or you is a small fry person. We're off the streets, we're a retail trader. We're sort of doing this of our own back. Nobody's giving us investment. It's all about from grassroots working up. Very few of us actually make it through to actually be doing this as a full-time income. But what I'm trying to demonstrate is, here is an example of how the simulation shows you what should happen based on the parameters of the system which I'm using. So I hope this has been a very sort of useful exercise. I mean, you might run this another time, and instead of saying 85,000, it might say 105. Another time you might run it, it might say 70. But the whole idea is to show you that over a sustained period of time, you are definitely going to have losing days. Yeah. I mean, look at here. Out of 1, 2, 3, 4, 5, out of 7 days, there was only one winner. Yeah. So you can have situations where within one whole week, or within a run of 7 days, you might only have one winner. Yeah, it can happen. It can happen, but the power of the reward to risk concept is that it always pulls you back. So just when you start worrying and thinking, oh my gosh, does this thing really work? All of a sudden it strikes back. Because you've got to understand, there's this thing called mean reversion, or balance, which basically means, if you're hitting a sort of downturn like here, where we've hit, within 7 days, we've already had 6 days of losses. It can't just go on and on and on and on and on, and it just can't do it. The way that probability works is that mean reversion, the trading results will mean revert, which means it will pull back like an elastic band. You stretch it, but it won't just continue stretching. There's going to become a point where it will snap. And so what happened here is, after these days, it snapped out of that downturn, and look, it went on 5 days of fantastic profits. The other thing to bear in mind is this whole thing called equity analysis, was something which I alluded to in my earlier webinars, about the fact that you've got to see one of the things that helps me in terms of my mindset is understanding that my trading results in terms of profits and cost. And so just like with any business where you've got profits and costs, whether it's an online business or a fixed fixed location business like a shop, a retail shop, you're going to have profits, you're going to have cost. You can't just have a business that you're running and you're earning money, and there's no cost. Even if you're doing internet marketing. Internet marketing is one of the greatest types of business models to alleviate costs. But even with internet marketing, you still have cost. You have cost of advertising, you have cost of marketing, you have cost of training. There's always going to be some sort of cost implication. And so what helps me in trading is that I understand everything in terms of cost. So for instance, here I've managed my first 3 days, I made £3,000. And then my next 3 days, I lost £1,000. So the way I look at it is, well, I had to spend £1,000 of cost to make £3,000. Yeah. look, I made the net cycle sequence is 2,300, but then after that I lost 900. So my my profits were 2,300, my cost was 900, and this follows you all the way through. There's very few times where the cost exceeds the previous profit interval. It may happen from time to time, like here, there was only £300 of cost as a time interval of profit, £300, but then the following day was 450. So sometimes that can happen, but most of the time what you're going to find with this type of model is that the cost are always going to be less than the previous profit sequence. So like 1650, cost here came to about £1,000. I mean, this was a monster week. I mean, this is a monster profit sequence compared to the £300 loss. Here, another monster sequence. So the reason I do this simulation is because what I'm trying to do is do this so that when you start to see my results, rather than having disbelief, you can always say, well, I saw the simulation, so I have a fair idea of what to expect. Rather than seeing Mel's results and saying, oh my God, how on earth can you have 7 days of Titanic results? No, something's not right. Something's shady here. That's not the norm. Well, it is the norm if you're adopting probabilistic trading principles and you've got the simulations to back it up. So I hope this has been quite useful, and whatever methodology that you're using, whatever reward to risk that you're using, I do recommend using Roll Dice Online, because I think it's a fantastic way of manually trying to simulate what you're going to expect in the future. So what I have here is an equity curve simulator. This is a tool which I've used in previous webinars. What I wanted to show you is a couple of things, and this again will help to manage your expectations in terms of understanding how I think. Okay, so I'm starting off with a £15,000 balance, yeah? And I've already said to you that the mean of my win rate over time is 43%. My reward to risk is actually 3.2 to 1, but I'm just going to keep it at 3 to 1 for now. I told you that I'm doing about 130 trades per month. Okay, now from March till September is 7 months. So if I'm averaging 130 trades per month, then essentially by the end of September, I should be doing in excess of around 910 trades, give or take, yeah? So it's simply 130 times 7. Now, what's quite interesting is the great thing about this tool is it gives you the option of whether you're going to use a fixed risk or a percentage-based risk. Okay, now I said I'm going to be using 1%. Now, what's quite interesting, actually, just thinking about it, this is what happens when you're doing webinars off the cuff. The manual simulation, which I just did, that was actually a very minimalistic model, because there were some assumptions. The assumptions it's making, or it's a model which is actually based on more of a fixed risk approach, because in that model the risk was always £150 per trade, wasn't it? So even though my account was going up week by week, the profit and loss for each day was still, the calculations were still constant. So that's one thing to bear in mind. So that 80,000, actually it could have been 120 or 130 if we were using a percentage-based risk approach. But this is where this equity curve simulator takes things to the next level, because I do have the option here of using, so I could either use 150 as a fixed risk, or I could just use 1%, and I'm going to just use 1%. Yeah? Okay. So what's quite interesting is when I actually do the simulation, it's telling me that after 910 trades, I should be hitting, what is that? I can't tell if that's 16 million or 160 million. Now, we know that's not possible. And the reason that's not possible is because of the fact that when you're doing a percentage-based approach and you're doing it as a simulation, the simulation hasn't factored into the equation the fact that as your size goes up, so is your greater demand, so is the greater the demand for liquid markets. So I'm not going to do this as percentage based, because I know that you know, if I get to the stage, if I was following this equity curve, this is all based on me getting to the point where I'm putting on trades where the liability is probably like £5,000. And I just know that the types of markets that I'm operating in, if I'm putting on trades where the liability is £5,000 and my win rate's going to slump considerably, because of the fact that it might take quite a long time for £5,000 to be taken up by the market, and during that time the market may have turned before my liability has actually been taken up. So that's one of the things about simulations, where it can actually paint a false sense of expectation. So this is something I just wanted to make you aware of. So what I'm going to do, just to keep it simple and keep it more realistic, I'm going to keep it at a fixed risk. So now this is interesting. So basically what we have here is it's telling us that after 900 trades, or by September, starting off with £15,000 with a win rate of 43%, I should be in the region of between 100 to 120,000 in terms of my bank. Okay, so 120 minus, you know, 15 takes us down to 100,000, around 100,000, 105. So essentially what this is telling me, this simulated model, is that, let me just run some simulations. As you can clearly see, I'm not making this up. The simulations are telling me that I should really be nearing my target of 90,000 or exceeding it, because I'm growing it from 15,000 and adding on an additional 90,000. Down, it's quite interesting. Down here you see what some of the average match drawdown. So remember, I was telling you that I'm kind of comfortable with my drawdown being as high as 15%. So if I keep doing the simulations, you can see that using 1%, the average match drawdown is kind of less than sort of 15%. If I was to increase, just trying to see if there's a way I can demonstrate this. I'll leave it for now. I was trying to demonstrate if I increase my risk, my percentage-based risk, but obviously with this model I'm using it as a fixed-based risk. So look, you can clearly see that the 90,000 project isn't a figment of my imagination. It's something that's clearly achievable. Yeah. And now one thing, observation I wanted to make, you're probably looking at this and saying, well, there's hardly any drawdowns because it's almost like a straight line. Yeah, that's what it almost seems like, a straight line. But that's because you're looking at it from a 7-month model. What about if we were looking at this from a monthly model? So to do that, rather than looking at 910 trades, which it would be for a 7-month period, let me look at 130 trades, which is what it would be for most months. So as you can now start to see some volatility. Yeah, the line isn't as straight as it is before, is it? It's clearly still going up in a positive direction, but you can now see that the journey to the destination is starting to vary. Some start off slow, some start off pretty high. I mean, this is showing you that you know, that there's a couple of dips here. So now you're starting to see that there's some volatility or variance from a monthly perspective, but it's still going in the right direction. What about if we looked at this on a weekly basis? So so on a weekly basis, it's about 35 trades per week. Yeah, let's see what happens. Wow, now you're starting to see, you're really starting to see the nitty-gritty of where variance is. I mean, I just missed that one, so what this is showing you now is that on a weekly basis there's a lot more variability. Yeah, so most of it is still going in the right direction. So most weeks I'm still going to be profitable. Right, look at this. Here's a week where I'm actually in less profit, and that's after 35 trades. So this comes back to what I'm saying, is that there will be weeks where I may be in a negative for the week, but it's not going to be by much. Yeah, it's not going to be by much, but it's just to show you that yes, I can still have losing weeks. But look how many simulations I had to go through to get to this. Yeah, so let's look at it on a daily basis. So on a daily basis, let's say on a daily basis I'm doing 5 trades. Well, here you see a lot of variance. Look, this is what can happen on a daily basis. On a daily basis, I could lose. Look, on this daily basis, within 5 trades, you know, so I mean, and the thing about it, on some days, if I hit the first 3 trades, it would simply just be a downward sloping line anyway. I wouldn't really give the market the time to probably rescue me. So it's a very important comparison here when you're seeing things from a different perspectives, because sometimes we can actually lose sight. And you know, if you're looking at it from a long-term perspective, you can clearly see that everything's working fine. But sometimes if you're looking at it from a weekly or even a daily basis, you could sometimes lose heart just because of the fact that the day's not going your well, but not realizing that it's just a very, very small increment in a much, much bigger picture. So with the automatic simulation, it's very good because it's able to show you the contrast between the 7-month view, the monthly view, the weekly view, and the daily view. So the daily and weekly view is where we started to see the nitty-gritty of how normal distribution works when you're dealing with a small number of trades. But as you start to deal with larger sample sizes, you can clearly see there's more consistency. And that's why one of the things I would recommend in terms of your trading development is where you are actually looking, you've got a particular concept or hypothesis you're working with, look at probably 300 trades as the minimum. Because in terms of my trading development, I found that after 100 trades, I started to see things that never happened in the first 100. And it was only when I got to 300 that I really started to see more consistency, and there were less hidden surprises. And so in terms of your trading development, I would always recommend, I mean, I always used to say, well, 100 should be okay. But I think if you really want to be on the safe side, you are looking at a minimum of 300 to 400 trades, because what that does, it basically allows the trading journey to really kind of come into its own. So you can see all the various nuances that may happen in terms of peaks and troughs, ups and downs, upward slopes, downward slopes, you know, banana skins, surprises, so that by the end of that 300 to 400 trade journey, you've got a much more solid picture of where your trading strategy lies. And too many times people are building strategies on the basis of 30 trades. You know, I mean, how on earth can you build a trading? How can you build any confidence in a trading strategy that is based on a percentage, which is only based on 30 trade sample size? So you're saying, well, there were 30 trades, and there was a 85% win rate. So wow, this is a fantastic thing to move ahead with. Well, come on, people, wake up. Wake up. First of all, you're talking about a win rate. You're not even telling us what the reward to risk. Win rate means nothing. I could show you a 95% win rate today strategy. Shall I tell you what it is? Basically, bet on Manchester City and Liverpool and Tottenham to win the rest of their games this season. Yeah, I bet you have a 95 or a 90% winning strategy there. But hold on a sec, I haven't disclosed to you that, if you back Manchester City, you'll win £12, but if you lose £100. Wake up, people. When you come across these system sellers and idiots that are selling this garbage, you need to basically confront them with the truth about how probability works. And say to them, well, how can you base something off a sample size of 30 or 50 when you need about 300 to 400 to be able to generate some confidence in the data? Okay, moving on. So the 90,000 project, what is it? Basically, it starts March the 1st. I will show my income results. And what I'm going to do is twice a month, the middle of the month and the end of the month, I'm going to log into my Betfair trading account and show you monthly totals or bi-weekly totals, monthly totals, and then I'll go into each day. So I'll then go into where you can actually pull up a report for each individual day within the Betfair trading environment. So again, I'll show you what I earned for the month. I will show you what I earned up until the middle of the month, and then I will show you the daily revenue. And the daily revenue, when you see the daily revenue, it should add up, should be consistent with what the bi-weekly revenue was and what the monthly revenue was. And the reason I'm doing this is because I think last year what I was doing, I was pulling down reports every day, and to tell you the truth, it was a bit of a strain. At least this way, number one, it offers you more transparency because I can't fabricate the results because I'm showing you my Betfair account. I'm logging in, and the great thing is that Betfair don't provide a demo account, so you can't accuse me of logging into a demo account. It's actually a real live account that you'll be able to see. What I will do on a daily basis that you can see though is I will plot my developing equity curve. So every day I will provide a link at the beginning of the project. I'm not going to be sending out this link every day. It will just be there for those that still want to follow me on a daily basis. And you will see my results added to the spreadsheet. And then obviously these results will then be validated by what I will do when I log into my Betfair trading account on a bi-weekly, well, essentially every 2 weeks, because the middle of the month and at the end of each month. What I'm also going to do as well is each month I'm going to publish 2 webinars. So every time or every 2 weeks, or when I am actually logging into my trading account to validate results, at that particular point in time, I'm also going to launch a webinar. So that webinar will basically be looking over the results, my thoughts on what's been happening, and possibly looking at a particular component of trading which I think is quite resonant with where I am with that particular month's worth of trading results. And ultimately the aim is to seek to achieve over £90,000 profit by the end of September 2019, starting with a bank of £15,000. And again, it's very important for me to contextualize this by saying £15,000, where I'm using a risk-based, percentage-based approach of 1% of my bank. Yeah, it's very important because that kind of tells you what's going to happen. Otherwise, I could be risking half of my bank to get to 90,000 and possibly doing it if somehow I was lucky enough to win the lottery and that happened, where I did 2 trades and got to 90,000, with the reverse flip that if it didn't work I'd blow my account. So what I'm trying to do is contextualize it that it's a £15,000 deposit and seek to achieve over £90,000 of profit by the end of September 2019, which basically means that my profit should be in the region of sort of 100,000, or my account should be in the region of 100,000, from 15,000 to 100,000. Yeah. So what's the purpose of this project? It's basically to show that a probability-based model is one of the most rewarding processes in terms of return on investment. It's very, very rewarding. And I used to, before I sort of got into this whole probability game, for me it was about, it was like developing a hypothesis, testing it. If it makes profit, then trying to streamline it to make more profit. But it was never probability based. It was just more profit based. How much more profit can I get out of this system that I'm using? It wasn't really, and then obviously I was then, when it wasn't working, then I was thinking, well, I need a high win rate system, and that was really the beginning of my downfall in that previous life as a trader. The purpose of this project is to show the effectiveness of a high reward to risk model. The purpose of this project is not to basically say that a high win rate or low reward to risk model doesn't work, but it's basically showing you from my perspective, this is what works for me. And one of the reasons why this is very important is because of the whole issue of scaling up. Because obviously as you scale up, it means that your liabilities are going to get bigger because your profits are going to get bigger. And I just know psychologically, if I'm dealing with a system that has a win rate of, I don't know, 80%, but you're risking 2 to make 1, if you're risking £100 to make £50, then the consequences of that approach are not really so apparent, because if you're putting on £100 to make £50 and it loses and you lose £100, then you might think, oh well, tough luck, didn't do it, I'll try again next time. But if you're putting on a trade where you're risking £2,000 to make £1,000, then all of a sudden it invokes a different set of emotional responses, because now you're thinking, hold on a sec, I'm risking £2,000 to make £1,000. If this trade doesn't work, I'm going to lose £2,000. Do you understand what I'm saying? Whereas with a high reward to risk model, it kind of works the inverse, because even when you're scaling up, because of the fact that your reward is so much more bigger than your risk, so even if I put on a trade where my risk is £1,000, I'm not so much worried, because I know that if it wins, it's going to be £3,000. Do you understand? So the purpose of this project is to show how volatility variance is controlled and minimized by risk management, cutting your losing days and pushing your winning days. We saw with the manual simulation that there were very few losing weeks. Very few losing weeks. I don't think there was a losing week actually but there will be losing weeks, but you're not going to have 2, 3, 4 losing weeks on a trot. Yeah. And also adopting the model of profits and costs, what you also see in the model is that the costs are simply just the net result of the fact that you've made profits before, and that's how you have to spin it. So when you get clumps or days of losing profits, especially with the model that I'm adopting, what you find is that, for instance, if you get 4 days, 4 consecutive days of losses, most of the time, 95% of the time, it's because that the previous cycle was a tremendous cycle of profits. Yeah? And that's basically the system, how the system maintains its balance. So you never have to worry when you have what you think is a slump, because I'm sure in most cases those slumps would have been following some significant periods of profitability. And so that's how you have to think in terms of your mindset. You can't just look at each individual day or each individual cycle, so a cycle of losses, in consecutive losses, and start really panicking about it. Because if you do, you're not really going to truly put yourself in the mindset to continue trading consistently until those profitable cycles come back. It's also to show that 100% returns on a 15k bank is not only possible, but a common occurrence over a sustainable period of time. Absolutely the case. Absolutely the case. You know, so you know, just going back to where did I go? If I go back to the okay, I wanted to go back to the manual simulation, but I'm not able to. But you will clearly see that you know, within a month I was generating, what was it, over 10k, 12k? Yeah, and that's just one simulation. On another simulation, so what I'm trying to show you is that, okay, even if it's not 100% return, it might be 70%, 80%, 90%. Sometimes it might be 120. It's possible. Don't think that with a 15, 20k bank that it's great if you only earn £10,000 for the year. Absolute garbage. Well, depending on the type of trading platform, trading system you're following, if you're following one of those sort of typical mediocre run-of-the-mill betting systems that's been sold, then yes, you might experience that type of return on investment. But certainly with the trading platform that I'm following, as you can clearly see, it's just on a different scale. To discredit the belief that you need a high win rate strategy to succeed, well, we've already seen that. And to show that probabilistic returns in sports trading are just as powerful as returns in currency and equities trading, if not more. And one of the advantages you have as a trader in sports trading is that, unlike the financial market trading, where you have bull markets, bear markets, and sideways markets, so you almost have to have 3 different strategies to cater for the market that you're in. With sports trading, because the rules of football are fixed, it basically means that for the most part, if you do find a winning formula, the chances are that winning formula will last long term, because the market conditions, the way that the market behaves, is always going to be consistent. I mean, there might be some slight nuances, but for the most part, you know, providing it stays as a game of 90 minutes, as a game of 2 halves, as a game where the object is to score, then you will find that if you do find a particular trading system, especially after 300-400 trades of testing, I'm not talking about where you found something after 20 or 30 or 50. Your sample size needs to be a lot bigger, and that's what I found from my perspective, and that's what's caught me out in the past. I was ready to run after even 100, thinking that, and then I was finding things happening in the live environment and saying, hold on a sec, I didn't see this in the back testing. Is there a problem? Okay, so the inspiration for this project, again, comes from an article which I've talked about before, how to get a 10% monthly return day trading. Well, they were only talking about 10%, but if you actually look at the fundamentals of what they're talking about, you can see that everything I've talked about today is pretty much based on what Corey was talking about in this article. Do a search on this in Google, and it will come up. I think the website is called thebalance.com. So the 90,000 project is going to start March the 1st. It's going to have equity curve daily updates, and then bi-weekly I will be doing validation of the trading results along with webinars to talk about the results and possible pearls of wisdom that I can glean from it. And the project kicks off March the 1st. So that's it, everybody. I hope you're excited to be on this journey. As I said, it's going to last for 7 months, and I don't know what's going to happen. I've done the simulations. I've got a fair idea as to what to expect. But ultimately, this is the game, a live environment for you to see. I've put my money where my mouth is. Whatever I preach, I have to try and live. We'll be fully transparent. You'll be able to see that transparency. You'll be going into my trading account with me to see that everything I'm talking about is consistent. You can't get more transparency than that. And ultimately, the idea is to show you that probability trading and the components and the fundamentals I talk about, that is what took me out of the quagmire. That is what got me out of the quicksand, where other people wanted to keep me down in ignorance. You know, these gurus on forums and self-proclaimed prophets of trading who have never achieved any sort of sustainable income over a monthly period or a yearly period. People that like to talk theory but don't understand that actually, in addition to the theory, there's a psychological component, and it's easy to talk theory, but what about doing it in practice? How do you react when you get 10 losing trades in a row? Are you going to still follow the methodology that you've been preaching? So that's why I hope that what I do is seen as something unique, different, a different perspective, and something that helps you in terms of your trading journey see what you can achieve by having the right mindset, methodology, probabilistic components, and help you to actually get to the point where you don't need to depend on, you know, tipping services or depend on another man who you've never met or you don't know. You don't know what his agenda is. You don't know whether the system he's really selling works over the long term. Develop your own thing. You know, use your own sort of creativity. That's what I always used to tell a lot of young people that I used to speak to about, that you have to use, you know, your God-given talents and your God-given creativity, because that's where you're going to feel most empowered. And when you've got something that works and something that can really, you know, help yourself and help your family, it then puts you into a new state of life where you can help to empower and build communities, and you know, the income you make, you can power it into helping communities or helping good causes, and you can also leave, you know, financial legacies for your children so that when they're growing up they don't have to struggle the same way you did. So this goes beyond just you know, looking at arbitrary figures of, you know, you want to earn this or you want to earn that. It's because the money is a means onto something else, and that something else is betterment of yourself, betterment of your family, betterment of your loved ones, betterment of the community, betterment of schools that need funding, betterment of communities that need infrastructure. That's where your level of thinking has to be. So it's all about, you know, you being provided the means to help others, as opposed to you just earning and all you're talking about is, you know, Ferraris and Lamborghinis and gold chains. I think, you know, when you adopt that level of mindset, it shows a level of maturity in terms of your thinking. So I hope this has been helpful, and hopefully I'll catch up with you guys around the middle of March, which is where I'm going to do my the sort of first webinar after web of results going live. And but if you want to keep updated in terms of how things are progressing on a day-by-day basis, then just go to this website, www.scientiatrading.com 90.htm, and you'll be able to follow things on a daily basis. I'm out of here. Peace. This is Mel.